The stock that tried to find you. Imagine you're walking through a supermarket on an ordinary Saturday afternoon. You're thinking about what you need to buy for the week. You're comparing prices, checking the shelves, perhaps wondering why everything seems to have become a little more expensive. And then you notice something. There's a particular product that's missing. You don't think much about it. You come back the following week, and it's missing again. So you ask the shopkeeper. He tells you that the product sells very quickly. Whatever arrives doesn't stay on the shelf for long. A few weeks later, you notice the same thing in another store. Then you start seeing people around you using it. Your neighbor has it. A colleague recommends it. Someone in your family has switched to it. Suddenly, something that looked completely ordinary has become interesting. But interesting doesn't mean investable. And that's where the story gets interesting. Because there are two ways of looking at what you've just seen. One person says, "That's a popular product." Another person asks, "Why is it becoming popular?" That second question is where investing begins. Not with a stock price, not with a target, not with a prediction, with curiosity. You want to know who makes the product. You want to understand why customers are choosing it. You want to know whether the company is actually benefiting from that demand. And perhaps most importantly, you want to know whether what you're seeing in the supermarket is large enough to make a meaningful difference to the company's financial performance. Because there is a big difference between seeing a business and understanding a business. And that difference is exactly where the story behind a stock begins. Think about what happens next. You find the company. You look up the stock. And suddenly your brain starts getting excited. Maybe I found something. That's the moment when you need to slow down. Because discovering something interesting doesn't mean you've discovered an investment. Imagine a detective walking into a room and finding a broken window. He doesn't immediately announce who committed the crime. The broken window is simply a clue. Now the investigation begins. Investing works in much the same way. The crowded restaurant is a clue. The product flying off the shelf is a clue. The increasing orders are a clue. The rapidly expanding customer base is a clue. But none of those things tells you to buy the stock. They tell you, look closer. And perhaps that is one of the most important habits an investor can develop. Don't turn every observation into a conclusion. Turn it into a question. Because the moment you start asking better questions, you start seeing the market differently. You stop seeing just a ticker. You start looking for the story behind the ticker. Now let's say you investigate that popular product. You discover that it belongs to a huge company. Sales of the product are growing rapidly. Customers love it. Everyone is talking about it. You might think you found something special. But then you ask one simple question. How important is this product to the entire company? And suddenly, the picture changes. Imagine a giant company selling hundreds of products. One of them becomes a sensation. Sales double. Customers love it. But that product still represents only a tiny part of the company's overall business. The product is a winner, but the company may barely notice the difference. And that teaches us something very important. A great product is not automatically a great investment. The real question isn't, do people love this? The better question is, if people continue loving this, how much can it change the economics of the company? That's a very different way of looking at a business. You're no longer looking at the product. You're looking through the product. You're trying to see the money behind it. Revenue, margins, profits, cash flow, market share, and eventually, value. That's where the story becomes more interesting than the headline. Because headlines tell you what happened. The story tries to explain why it happened. And that is the difference we want to keep exploring whenever we look at a stock. Now imagine something else. You discover a restaurant in your neighborhood. 6 months ago, you could walk in anytime. Today there's a queue outside. 3 new branches have opened. They're crowded too. The same customers are coming back. Now most people might simply say, this restaurant is doing really well. But an investor can ask a more interesting question. Can this business repeat what it's doing? That's a much bigger question. Because if one restaurant works, that's interesting. If the same restaurant can work in 10 cities, that's a business model. If it can work in 100 cities, that's a growth engine. And suddenly, you're no longer asking how popular the restaurant is. You're asking how large the company could become. This is where some of the most interesting investment stories begin. A company doesn't necessarily need to operate in a rapidly growing industry. Sometimes it simply needs enough room to take customers away from competitors. A relatively ordinary industry can contain an extraordinary company. And that is something worth remembering the next time the market becomes obsessed with the latest fashionable industry. Sometimes the opportunity isn't in the industry everyone is talking about. Sometimes it's in the company quietly taking market share inside an industry everyone has stopped noticing. That's the kind of story worth looking for. But even here, there's a catch. Growth has a runway. Imagine that same restaurant company eventually opens thousands of locations. At the beginning, adding 10 restaurants could transform the business. Later, adding 10 restaurants barely matters. The company has become so large that maintaining the old growth rate requires enormous amounts of new business. This is the mathematics of scale. A small company has more room to surprise you. A giant company needs much bigger opportunities to produce the same kind of surprise. So when you see a company that has grown rapidly for several years, don't simply ask, how fast has it grown? Ask, how much room is left? Maybe the company has captured only a small part of its potential market. Maybe it has already captured most of it. Those two companies could have exactly the same growth rate today, but completely different futures. And that's why the past is useful, but the future is what matters. The numbers tell you what the company has already achieved. The story asks what it can still become. And that gap between what a company is today and what it could become is where investing gets fascinating. But not every company is a growth story. Imagine a steel company. The economy is strong. Construction is booming. Demand is rising. Steel prices are high. Profits are excellent. The stock looks cheap compared with earnings. It is tempting to look at those numbers and say, what a bargain. But there's another possibility. Maybe the company isn't permanently earning this much. Maybe the industry is simply at a favorable point in its cycle. If demand weakens, prices can fall. Margins can shrink. Profits can collapse. And suddenly the stock that looked cheap wasn't necessarily cheap. You were simply comparing the price with unusually high earnings. This is why understanding the business matters. The same number can mean completely different things, depending on the type of company producing it. A fast-growing company needs one kind of analysis. A cyclical company needs another. A turnaround needs another. An asset play needs another. And that leads to a powerful investing lesson. Don't just ask whether a stock is good. Ask what kind of story you're looking at. Because the wrong expectation can turn a good company into a bad investment. Imagine buying a stable, mature business expecting it to become 10 times larger in a few years. You might eventually sell in frustration because the stock isn't moving fast enough. But perhaps nothing was wrong with the company. Your expectation was wrong. Now imagine buying a cyclical business because its earnings look spectacular. You might believe you're buying a bargain. But perhaps those earnings are close to the top of the cycle. Again, the company isn't necessarily the problem. Your interpretation is. This is why understanding the character of the business matters. Some companies are slow growers. Some are stalwarts. Some are fast growers. Some are cyclicals. Some are turnarounds. Some contain hidden asset value. The categories aren't meant to put companies into permanent boxes. They're meant to help you understand what kind of economic story you're dealing with. And companies can change. A young, fast-growing company can eventually become a mature business. A cyclical company can get into serious trouble and become a turnaround. A turnaround can recover. A successful company can accumulate assets that eventually become an important part of its value. The business changes. The story changes. And when the story changes, your investment thesis should change too. That's why following a stock is really about following the evolution of its story. Now imagine a company whose stock has fallen dramatically. Everyone hates it. The business has problems. Management has made mistakes. Debt is uncomfortable. The market has already decided how the story ends. But inside the company, something begins changing. Management starts selling unwanted businesses. Costs come down. Debt begins reducing. The core operation becomes healthier. Customers begin returning. Now you have something interesting. Not because the stock has fallen, but because the business is changing. That's the difference between a cheap stock and a turnaround. A stock falling 70% doesn't automatically make it a turnaround. A low price doesn't repair a business. Change does. And that's another reason why price alone rarely tells you the complete story. The chart can tell you that the market has lost confidence. It cannot, by itself, tell you whether the business deserves to regain that confidence. For that, you have to look underneath. You have to find the story. And sometimes the story is hidden even deeper. Imagine buying an old house. From the outside, it looks ordinary. But later you discover that the land underneath it is extremely valuable. Suddenly, the house isn't just a house. There's something else underneath the surface. Companies can sometimes work the same way. The operating business might look ordinary, but perhaps the company owns valuable land, cash, investments, infrastructure, or other assets. The market may be focused on what the company earns today while overlooking what it already owns. That is where an asset story begins. And again, the lesson isn't to automatically buy the stock. It's to ask, what am I missing? Because sometimes the most interesting part of a company isn't the part everyone is looking at. Sometimes the real story is hiding underneath the obvious story. And now let's return to that supermarket. Remember the product that kept disappearing from the shelf? At the beginning, you saw product. Then you saw business. Then you started asking why customers were choosing it. Then you started looking at the company's economics. Then you asked how much room it had to grow. Then you tried to understand what kind of company it was. And finally, you started asking what could make your entire story wrong. That last step might be the most important. Because once we become interested in a company, our brains naturally want to prove that we're right. We notice the good news. We ignore the warning signs. Every positive development becomes confirmation. Every negative development gets explained away. So here's a useful mental model. Don't become the lawyer for your stock. Become the prosecutor. If your story is that the company will gain market share, ask what could stop it. If your story is that earnings will recover, ask what could prevent that recovery. If your story is that the company can grow rapidly, ask how much runway remains. If your story is based on hidden assets, ask whether those assets can actually be monetized. If your story depends on a turnaround, ask whether the business is genuinely improving. Because the goal isn't to find reasons to buy. The goal is to discover whether the story survives serious questioning. And that is where investing becomes much more than numbers. The numbers tell you what happened. The business tells you why. And the story helps you think about what might happen next. That's why two investors can look at exactly the same company and see completely different things. One sees rising earnings. Another asks whether those earnings are cyclical. One sees rapid sales growth. Another asks how much runway remains. One sees a collapsed stock price. Another asks what has actually changed inside the business. One sees a popular product. Another asks how much that product contributes to the entire company. The information is the same. The questions are different. And sometimes, the advantage isn't having more information. It's knowing which questions are worth asking. That's what makes the idea behind stocks so powerful. We're not simply interested in the stock that moved today. We're interested in understanding why it moved. We're not simply interested in a company with growing profits. We're interested in understanding what is creating those profits. We're not simply interested in a cheap valuation. We're interested in understanding what the market may be missing. Because every ticker has a business behind it. And every business has a story. Some stories are about growth. Some are about recovery. Some are about cycles. Some are about hidden assets. Some are about changing consumer behavior. And some stories simply don't deserve your money. The challenge is learning to tell the difference. So the next time you walk through a supermarket and see that product missing from the shelf, don't immediately reach for your trading app. Pause. Look again. Ask yourself why. Maybe there's nothing there. Maybe it's temporary. Maybe the company is struggling with supply. Or maybe you've just noticed something that hasn't become obvious yet. You won't know until you investigate. And that's the whole point. You don't need to turn every observation into an investment. You simply need to become better at recognizing which observations deserve investigation. Because the market is constantly giving you clues. The question is whether you're paying attention. And when you find something interesting, don't rush to buy it. Follow it, question it, test it, understand it. Then ask whether the price makes sense. Because the market will always give you a price. The chart will always give you movement. The headlines will always give you excitement. But somewhere underneath all of that is a business. And that business is telling a story. The price is what everyone can see. The story is what you have to discover. And that is where we keep looking. At the story behind stocks. Not just the ticker. Not just the chart. Not just the headline. The business behind the price. Because sometimes the most interesting investment opportunity isn't the one someone tells you about. It's the one you notice yourself. And the real skill isn't buying it first. The real skill is understanding it before you decide. That is the difference between watching stocks and understanding stocks. And once you start looking at the market that way, you may never see an ordinary supermarket shelf, crowded restaurant, busy road, or growing business quite the same way again. Because behind everyday life, there may be a business. Behind the business, there may be an opportunity. And behind the opportunity, there's always a story. That's the story behind stocks.